One of the things I've noticed tends to happen, and I've been investing for 50 odd years, is things which do well in the first few days and first month of the year tend to be the things you want to be holding for the whole year. And I couldn't help noticing that despite the very small rise in gold, well, which is about 1% or something like that, the GDX and GDXJ, these are the indexes, ETFs, which track the gold mining shares, rose. They took a very large jump, something like 5%.
Monaco 64, home of alternative economics and contrarian views. So Clive is back. He had a long holiday. He's a bit lazy, Clive. No, I'm joking. Clive, Happy New Year.
Happy New Year to you, Mario. Happy New Year to all your listeners.
Yeah, Happy New Year to everyone. And Clive, if you look at those of us, I mean, and I do have other assets, but mainly it's gold and silver, physical gold and silver. So my portfolio in pounds was up 23.5% in terms of silver, which is not the biggest holding that I have. It's gold. And in gold, it was up 29.4%. And I see that for you, Clive, in Swiss francs, gold was up 37% and silver 31%. But I want to hear from you as well because fund managers, private bankers, people who look after people's assets, they diversify more, even though I personally think if you believe in something and you know about that asset and you think it's going to do well, I'm not really too much into diversification. But yeah, so maybe you can talk about how your portfolio did in 2024 and what are you looking for in 2025? And it's not to like have a go at you. I just want your opinion.
Yeah. So, well, first of all, as you said, Mario, the gold and silver portion of the portfolio did absolutely fantastically. But I don't really look at the gold and silver as part of the portfolio. I kind of see them apart. And I wish I'd had the majority of my assets in gold and silver. Unfortunately, I don't. I publish about once every year and a half an asset allocation table. I put it on LinkedIn, and it's designed for multimillionaires, and of course it's not right for everybody, but broadly speaking, that has, and it hasn't changed since I did it, 12% exposure to gold and silver, or precious metals if you like. Of course, if you'd put 12% in precious metals when I first published it, it'd probably be more like 15 or 18 or 20% now. But I kind of keep it constant as an asset allocation. And broadly speaking, that's roughly where I sit. But I think it's not fair to talk about the portfolio management performance when I only look at the gold and silver, because otherwise people say, wow, you're a genius, you made 30+%. What I do every year also is I go onto LinkedIn and publish a portfolio for the equity proportion of my portfolio. So this is kind of a brave thing to do because not many investment managers have the courage to put their portfolio up, or at least what they recommend people should invest in. But I do that every year. Last year I put up, I called it the 2024 Beat the Benchmark portfolio. That had a performance of around 15 odd percent. And it was weighted something like 84% outside the USA and 16% inside the USA. So it didn't beat the S&P 500, which was up 20 something percent. But I don't think that's the S&P is really a relevant benchmark. And I never took that as my initial benchmark. My initial benchmark was 84% the World Equity Index, excluding USA, and 16% the US GARP index. GARP stands for Growth at a Reasonable Price of the S&P 500. So if I combine those two indexes together, I get about 7% return combined on those two indices, bearing in mind that the S&P 500 isn't either of those indices. So the index I was looking at was the Growth at a Reasonable Price index in America, the S&P 500 GARP. If I combine those two indexes together, about 7.5, I had 15, so I was about 7% ahead of the benchmark, or at least of the benchmark I set myself at the start of the year. So I'm quite pleased with that. Um, the thing to say about the S&P 500, I wouldn't include it as a benchmark, although many people do. But the reason I wouldn't include it is that it's a very unbalanced benchmark. First of all, it's all US stocks. And if you're living outside the USA, it makes no sense to have all your assets in the USA at all. I mean, quite the opposite. And the second thing is, in terms of the components of the index, it's also extremely unbalanced because 35% of that index is comprised of the seven largest stocks, basically Microsoft, Amazon, Apple, Nvidia, Meta, which is Facebook, Alphabet, which is Google, and so on, and Tesla. So it's a very unbalanced index. Nobody in their right mind would say it's the right thing to have 35% of your portfolio, your equity portfolio, in just seven stocks. I mean, people do it, but I don't think it makes sense. So I wouldn't use that as my benchmark, even though many people do. Now, in terms of looking at portfolios in European banks, I've had a few a number of feedback from people. The best performances that people are getting are sort of in the order of 12%, 13%, 14%, that sort of level. But much more often it's in single digits. That's perfectly acceptable when you think that you could only get 4.5% on a deposit. But obviously a lot of people are saying, gosh, I only got 8% or 10% when I could have had 24% if I'd invested in the S&P 500, or if my banker had been smart enough, he'd put me in gold and I'd
Yeah.
have had
In
25, 30%.
euro, gold went up 35.6%.
Yep.
So
So, I think that in the coming months, a lot of European investment managers are going to get a bit of a kick from their clients who say, you didn't beat the index, because they weren't. People don't actually realize that the index shouldn't be the S&P 500 and shouldn't be only gold. But I think there'll be pressure on the portfolio managers to put a little bit more gold into portfolios. The other thing I think which will happen is people will be saying, did you have any Bitcoin? To which the answer will be 99% no. I don't think portfolio managers are going to change their mind very quickly, but of course the pressure will be on over time for them to do so. But people at the top of the pile, the chief investment officers, quite often value their jobs and don't want to put their neck on the line by doing something which is different from everybody else.
yeah, I kind of agree with what you said about gold. No one's going to put everything in gold and silver unless you're like me. And I have to say that my mining stocks, they did come down. They were down on the year, but a small percentage compared to what I have in mining stocks to what I have in gold and silver. So I guess the 29% that I made in gold is going to come down maybe 3 or 4%, but it's still okay. One thing I would say though, Clive, in the same world where you have sound money, gold and silver, of course, are money. So they should be the measuring stick for equity investments, for bond investments, for commodity investments. And I think a lot of people still see gold and silver as commodities. If you go on the mainstream media, like Bloomberg or FT or whatever, they always put gold and silver under commodities, even though you can bring up gold and silver as currencies like XAU, USD. It's kind of confusing. But I wrote this, Clive, and I'm going to share it with you and the public here and the viewers. I wrote this back in 2006. I used to keep this blog called forsoundmoney.com, and this is while I was still working in the city for a company. I did this privately, and I said that the fiat currencies, they're all sinking, and and look at where the gold price was at the time, 651, silver 13. And I wrote a part two 6 months later. And my point here is not to brag about this, Brad. Clive, is to maybe propose, and I don't know what you think and whether you can do this, to build a portfolio where the currency in which the portfolio is denominated is in gold, and then you can compare, yes, equities, bonds, and commodities to gold. I think that would be a much better way to measure performance because since the year 2000, gold is up about 9 or 10% every year versus the major currencies. Do you think that's something crazy or that's something more and more people are going to start doing?
Well, Barry, I have to start by saying I think it's crazy, but it's also something which I used to try. If I go back over the decades, many decades, I mean, I've been a believer in gold ever since 1970s, really. And I used to try it. I used to put my portfolio in gold and value it in gold. But you know why I thought it was crazy? Because gold often, over and over again, beat my performance in equities, and in the end, I said, "Look, this makes no sense for me because I'm showing myself up. I should be in gold, not in equities. And I don't want to be I don't want to be only in gold. I want to have equities and other things and property and so forth. So at the end of the day, I kind of stopped measuring it in gold. Of course, if I would have measured my portfolio performance in gold over the last couple of years, the performance and that of every other bank would be looking absolutely terrible. So it's a crazy idea if you want to feel bad about everything else, but I suppose in a way it's the accurate way to do it because we all know that historically gold has been the money and is the true measure of how valueless or how fast your fiat money is losing its value.
Well, and Clive up until 1971, and definitely prior to 1933. If you really think about it rationally, if you go through the process, all portfolios were measured in gold. The term dollar was just a way to gold. I guess it's crazy because, like you said, it makes it very hard for fund managers and stock pickers to actually do well. And I think, yes, that's I think it will change. But anyway, Clive, there's some news this morning, and I don't know how much you follow this, but I've seen people like Rafi Farber. He's followed this quite a bit. The reserves at Fed sink below 3 trillion to lowest level since 2020. So it says here the 326 billion drop in week to January 1st was biggest since 2022. And Rafi has spoken or written in his report in the last few months that if we went below this 3 trillion, there could be trouble in the banking system. And this is what they're saying here as well. That, as you see here, U.S. banking systems reserve, a key factor in Fed's decision to keep shrinking its balance sheet, tumble below 3 trillion, lowest level since October 2020. So we're now at 2.89 trillion. And they said that the last time that reserves fell sharply was like in 2019 when they had the repo crisis. So have you
Yeah.
got an
So
opinion on that?
yeah, I mean the reason banks keep reserves at the central bank is in case their depositors come for cash. So let's say it's Christmas or whatever it happens to be, and all the depositors turn up on the same day because they want to go Christmas shopping, want to draw the cash. You can't call in the loans that you've lent to corporations or to the credit card companies or to the private individuals because they can't repay. So you have reserves at the central bank, which you can call on literally overnight. You can say the central bank, send me back 1 billion or send me back 100 million, whatever it happens to be, and they'll send it to you. And that way you always have enough on hand to pay out the depositors. So what's this potentially showing? It's either showing that the banks don't think their depositors are going to come calling for the cash, or maybe it shows that the depositors have already come calling for the cash and they don't have too many reserves left. But the problem would be if those reserves drop too low, there's less ability for the banks to handle a crisis when there's a run on the bank and people say, I'd like my money out, because they can't then immediately go to the central bank and say, give us our reserves back. They have to strike a deal with the Federal Reserve saying, please, would you take something else off us, like mortgages or loans or commercial loans or something? And then it's down to the Federal Reserve to agree with that and lend them the money, which obviously is a different kettle of fish than taking your own money.
Yeah, and it says here because the Fed's still doing the reverse of QE. And at the end, it says the recent reinstatement of the debt ceiling is likely going to make it more difficult for policymakers to judge the ideal level. And it says two-thirds of respondents of the New York Fed's open market desk survey of primary dealers and survey of market participants expect QT to end in the first or second quarter of 2025. I think that's another reason why we are going to probably see gold and silver continue to do well, that they're going to stop QT, and we're still going to be at a much higher level, the Fed's assets or balance sheets than it was prior to 2020, because this is where it was here, Clive, when the repo crisis started, when the reserves dropped a lot, it was here, the Fed's balance sheet. And now they're saying that they're going to stop maybe down here in a few months, and it's still a lot higher. And in my book, that's inflationary.
I think that's right. That's also my opinion, although I was sort of pushing it a bit further out to the third quarter of this year. The the reason this is going to happen, first of all, we've gone into the debt ceiling yesterday, so we have a new debt ceiling. It doesn't mean to say the Fed, that's not the Fed, the Treasury can't keep borrowing because they've had a large tax or refund from one of the funds, the social benefit funds, which means they can keep going for another 14 days before they have to start doing what's called emergency measures. So what does the debt ceiling mean? It means that the US government is not permitted to borrow any more money than the current level of debt until such time as they raise the debt ceiling. Now, there's a discussion going on to see whether they can actually get rid of that debt ceiling completely. But every year or so, every 2 years, they have this new debt ceiling, which they're not supposed to pass. And here they are. They put this new debt ceiling. It was something which was agreed about a year and a half ago. They agreed that the level of debt at the 2nd of January 2025 would be the absolute level of debt allowed until they agree a higher ceiling. So now the negotiations are going to start. Those negotiations might, if history is any guide, those negotiations about the new debt ceiling might continue for many months. But in 14 days, they'll hit that debt ceiling, and Mrs. Yellen will have to start carrying out emergency measures, emergency procedures. She hasn't specified what that actually means, but if we look at the history, it basically means they'll run down balances in other agencies, they'll use up the remaining cash balance, and then they'll start resorting to raiding the government pension funds. Now, when they've done this in the past, they've always said, we don't have any money to rely on, but we have to keep paying our bills, so we're going to borrow or force the pension funds, these are the government pension funds, to give us the money. And then once we get the debt ceiling raised, we'll refund the pension funds in full with interest. That's what they said, and I assume that's what they did last time. So
right now, debt ceiling is around 36.3 trillion, because that's where, I mean, yesterday is probably a little less, right?
Yeah, I read that it's supposed to be capped at 36.1 trillion. So I'm not, anyway, that says 36.3. So
maybe it was the day before the second they take, but
yeah.
it's moving up so quickly.
So the question is, what will happen when they raise the debt ceiling? And here I'm assuming they will, because we don't know that, but let's assume they will. When they raise the debt ceiling, they're going to have to rush into the market and borrow an absolute ton of money to replenish the coffers. Now, at that point, it'll mean there's a lot of pressure to sell Treasury bonds, Treasury notes, and Treasury bills. And it depends on the appetite for investors at that particular moment. We don't know how things are going to be looking when this happens. But depending on the appetite, there may not be enough appetite at today's interest rates to absorb all that new issuance. So it could well be that interest rates get squeezed upwards. And I think there's a point beyond which the Treasury doesn't really want to go. And I don't know where that is, but I'm going to say it's probably somewhere between 5 and 6%. Maybe 5% is just acceptable, five and a quarter, so 5.5%, they're not liking it very much, and 6%, they're in panic mode. So if interest rates start to get squeezed up, and there's lots of reasons why they should be, ignoring the debt ceiling story. If interest rates start to get squeezed up at the 10-year end, I'm talking about 10-year bonds here, then I see it quite likely that the Treasury will lean on the Federal Reserve to help out. How does the Federal Reserve help out? Well, it's invited to buy government bonds, just as they did in the global financial crisis, just as they did in the pandemic, and it'll happen again. They'll be invited to buy bonds. So what they'll have to do is print money, electronic money, so they can pay the government to buy those bonds, and then the government could then go and spend that money on whatever they choose to spend it on, the army, Medicare, social services, whatever they spend, unemployed, all those things that they spend the money on. So if that happens, that means that the Federal Reserve's balance sheet is once again starting to expand.
Yeah, and Clive, just to clarify, the Fed would not go directly and buy at a Treasury auction because that would look really, really bad. What the Fed has to do is they have to wait until the Treasury issues a new 10-year, let's say, on Wednesday, and then the primary dealers and investors buy it, and then the Treasury, the Fed comes in and buys it from the primary dealers, and the primary dealers make a small profit. It's really easy money if you're a primary dealer. But I spoke
Exactly. It's
about
a gravy trade, isn't it?
yeah, I spoke about primary dealers though, I think yesterday or the day before, because they're worried now, Clive. You would never have guessed it, Clive. They're worried because there's so much debt coming online that they can't cope with it. They're saying, in 10 years' time, there's going to be 50 trillion that we need to deal with. And I looked at the numbers, Clive, and back in 1995, there's only the market for treasuries was only 1.9 trillion. So how are these people going to cope with it? I think it's going to be really hard to do that. And Clive, I want to switch over to the UK now, and then we'll look at the dollar because the dollar, even though the dollar dropped quite a bit versus real money, i.e., gold yesterday, it rose against quite a lot against the pound and the euro. I think it was up 1.2% versus the pound and 1% versus the euro, but it dropped even more versus gold. But uh, and that's the gripe I have, and that's why I try to wake people up that you got to think in gold because all these currencies are sinking. But anyway, here in the UK, this came out this morning. UK heading for tax rises despite return to growth, economists say. So what they're saying here, Clive, the UK Chancellor and government did such a bad job to try to get business going again. They've punished business. They've given loads of money to the public sector. I went out this morning, Clive, with Rudy before 7. And Rudy likes to go into this shop, and they know him there, and they give him some treats. But the other thing I do is look at the newspapers. And they've got all the newspapers already there, and one of them said that there's an extra 1.5 billion that they're spending in wages for the NHS. But that's a different topic, but it says here most economists expected only a tepid rate of expansion this year, short of the 2% rebound the Office of Budget Responsibility Fiscal Watchdog anticipated. So what they're saying is that GDP and growth is going to be lower because they're punishing businesses. They're doing things that don't help businesses, like increasing the national insurance employers' contributions. And now, yeah, about 90% of the people that were questioned said that they expect more tax rate hikes to make up for the shortfall in tax receipts. It seems to me like a vicious circle into more and more, yeah, poverty, not very much prosperity. What do you think, Clive?
The more you go down the road of taxing people and taking off the the fruits of their hard-earned labor, the more they say, "Why do I bother?" Or if they are going to bother, they start to say, "Where can I go where I won't pay these taxes?" So I think if you remember back in the 1960s and 70s, there was what's called a brain drain in the UK, where anecdotally people said anybody with any brains, I, those who earn a lot of money, will leave the UK. And many of them did. And, I think we're getting back into that sort of situation where people are starting to say, uh, there's a level beyond which I won't put up with it. And so I do think that Britain will lose talented labor for other climes. And with that, they'll lose the taxes they get from the worker, and they'll lose the taxes they get from the VAT and other expenditure that the worker's putting back into the system by spending his money. A very good example of this, of the taxation of the UK, which I saw a few months ago, was they've imposed VAT on private education. Now, if you work through the government's own numbers on this, obviously they say it's going to collect so many billions in taxes because people are going to pay VAT because their school fees go up from 15 to £20,000 because of the extra VAT. But when you work through the government's numbers, and I'm not talking about numbers that I made up, these are numbers which are on the government's own website, you see that over a very small number of years, there'll be sufficient number of schools, private schools, which close down. There'll be quite a few families who say, I can't send my children to school at these prices anymore. There'll be some families who can't send their children to a private school because the private school will have closed down. So there'll be teachers who've lost their jobs. There'll be private schools which will close down. The schools will, because they'll be now VATable, will also be able to reclaim the VAT that they've incurred. So the tax saving that they are hoping to get isn't there. And when you put all the numbers together, you'll find that this exercise of charging VAT on private education is actually going to have a negative effect on the government's finances because they're now going to have to be educating an awful lot more school children who would have otherwise been educated out of the finances of their parents. So, and of course, the extra cost of income taxes and what do you call it, national insurance, all of these things are eating in to those who are working hard, what they're getting. And well, one might say those who've got jobs are very privileged, but there comes a point where people start to say, it's not worth a biscuit.
Yeah, and it's interesting, yeah, because now the private schools are going to be able to claim VAT on a lot of the stuff that they buy. That so it's not, and the other thing as well, when there's no VAT in private education, people kept their children in the private schools, but they were also contributing to the state schools because they were paying the national insurance. So, like, I think it was just a political move and it doesn't work, but that's how politicians work. And talking about that, Clive, about the UK, I don't think Europe is much better. And that's why maybe we saw this yesterday. The dollar surges against euro and sterling. But as I said, gold did it even better. But you can see why investors might be betting on the US, especially with all the policies that the future administration is supposed to bring in, deregulation. But do you think the dollar can continue to go higher in terms of the dollar index? And the one thing I would note to the viewers is that gold doesn't always go the inverse way of the dollar index. If anything, since 2008, when the dollar index hit like a level just above 70, gold has gone from 1,000 to where we're now, which is 2,650. But I'd like to know what you think about this, Clive.
There are signs of strain in the euro system. That's the euro as a currency, and we're seeing that because the interest rates on European government bonds, I'm talking about France, Germany, Italy, Spain, and so on, are diverging. Now, when the euro came into existence, all the interest rates on 10-year bonds or 3-year bonds or 5-year bonds started to converge.
Yeah.
Then we had they became roughly the same. Then we had the financial crisis. So there was 4 or 5 years from 2008 onwards when the interest rates diverged, and then they started, particularly because countries like Portugal, Italy, Greece, Spain, Ireland were potentially going to default. And that was a big, big worry at the time. So the interest rates on those types of bonds started to diverge again. And now they've come back together, or did come back together. But we've seen in the last year or so that these interest rates are once again starting to diverge. It's indicative that there might be some sort of crisis brewing. The interest rate I haven't got in my head, but I think on French bonds, there's something like 1% higher than German bonds of the same maturity. Now, they're both in the same currency. They're both supposed to be core members of the European Union, yet you have very different interest rates. Now, if the risk was exactly the same, you could borrow you could borrow euros at the German central bank rate and deposit them on a 10-year French bond and make a 1% difference every year. And then you leverage it 100 times, you're making 100% a year. Now that's obviously ridiculous and nobody's really doing that. But if you do that sort of deal, you're obviously taking the assumption that the risk of the two is the same, but clearly it's not, and that's not what the market thinks. The market thinks that the interest rate is telling us a story that the chance of you getting repaid from some European countries is considerably less than from others now.
Yeah, and you can see here what Clive was talking about. You see the Greek bonds, they were yielding like almost 8% when the euro kicked off in the late 90s. And then it converged. They all converged, and they did really well, in terms of converging. And then they all went up together during in the late stages of the housing or mortgage-backed security boom, and then they all went down. But then they started diverging here. This is where that European sovereign debt crisis was. And I remember the 10-year Greek bond went up over 40%. And it doesn't show it here, but so what Clive is saying, we're starting to see a little bit of that, right? And that's really a danger to the euro.
And I think I'd like to be very clear to all of your listeners. It is entirely possible that a European sovereign state can default on their obligations to you. It already happened to me personally with respect to Greece. I held in the sovereign crisis Greek bonds and actually bought them at a massive discount. But the one thing I did expect was to be treated fairly with all other investors. What I did not expect was to see the European Union forcing Greece to change the law so that the European Union could dictate what would happen and the ECB gets paid in full when everybody else gets tuppence. So, that was a clear default. They didn't call it a default because under the rules, they changed the rules so that 30% holder of the bonds, that's the EU, could basically change the rules and dictate what they liked. So it wasn't a default. But of course, it was a default if you didn't get repaid what you owed.
So I guess the people who benefited were the major central banks, like the Bundesbank, who were holding
Yes.
that
Yeah,
debt.
this was done. I mean, private investors took the EU to court over this because they were deprived of uh, uh, their what they call the pari passu rule. The pari passu means all investors are treated equally. If some investors get 40%, everybody should get 40%. If some get 20%, everybody should get 20%. If you don't have a pari passu rule, some people get 100%, the ECB, and other people get nothing or tuppence halfpenny, which is what in fact happened. So the EU was taken to court, and whilst the EU agreed at the highest court that private investors had been deprived of their money, they said saving the European Union and the euro system was more important, and therefore the action was justified, and therefore no compensation was due to private investors.
I guess that must have made you determined to have even a little more gold and silver outside the system.
Yeah, yeah. I mean, well, it's made me determined to have more, but it also makes me determined to be. I don't own any, but to be very, very cautious if there was any suggestion that I should be buying government bonds. I wouldn't be buying government bonds in any European country at the moment, and certainly not Greek bonds, which are currently yielding less than French bonds.
Would you still buy U.S. Treasuries? Do you trust Uncle Sam?
I think it all depends on the time scale of the region. Now, if you need a cash balance and you're dollar based, and you think you might need some money for emergencies or for an opportunity which might arise, yes, but no harm with that. But I'd say at the short end, the Treasury bill or less than 2 years. But if you're saving for your retirement, you are going to find that those things you'd like to spend your money on in retirement will have risen in price far faster than the consumer price index. And
Yeah.
when I talk about the things you're going to spend your money on in retirement, I'm talking about the nice things in life, the things that people deserve when they retire, such as a nice home, a nice car, going on holiday frequently, good medical care, perhaps some lovely ornaments or pictures, paying for the school fees for their grandchildren, all these sorts of things that you want to do as a now wealthier person, hopefully wealthier in your retirement, will cost a lot more and will have risen in price far faster than the consumer price index. Because don't forget, the consumer price index is based, broadly speaking, around things which are mass produced. Mass produced things are made by robots. And therefore, the price doesn't change nearly as fast as the amount of money which is available on the planet to buy things which are in short supply.
Yeah, that's right. And I'm just trying to bring up something for you here, Clive. This is a pretty good chart here too. Oh, hold on. You there?
Yeah, I'm listening. I was
It's
just
all
wondering.
right. I was going to bring up a chart of the price of
Uh,
the price of gold in treasuries, and it's been going up as well. So that's another reason why, yeah, I wouldn't hold government bonds in the long term, because the other thing is I think the bond markets are rigged in that investors still buy into what is called inflation or CPI. Those are adjusted all the time. So I don't really think you're getting a real yield that will really compensate for the debasement of the currency. So Clive, so today, yeah, our first talk of the year. Anything specific that you want to say about
well,
2025 to the viewers?
one of the things I've noticed tends to happen, and I've been investing for 50 odd years, is things which do well in the first few days and first month of the year tend to be the things you want to be holding for the whole year. And I couldn't help noticing that despite the very small rise in gold, well, which is about 1% or something like that, the GDX and GDXJ, these are the indexes, the ETFs, which track the gold mining shares, rose. They took a very large jump, something like 5% in the first day or two of this year. So it could well be that portfolio managers now starting a new year are saying, what can I put in my portfolio which might have a good performance? So I don't know if you put year to date. There you are. It's up, what's it say? 2.46 on the, which currency is that? It's USD.
Yeah,
So it's had these ETFs have had a much larger jump
yeah,
than the gold price itself. And I think maybe portfolio managers are starting to put a little bit of gold mining shares into the portfolios.
yeah. GDXJ, that's almost 5% yesterday. So
Yeah.
yeah, I noticed that because well, I think yesterday was the first day of trading because January 1st there's no trading. So yeah,
Yep. Yep. It was the first day.
silver
And
also.
we've got but just a small comment. I think something to keep your eye on this afternoon. Congress goes back into session, and of course there'll be maybe some discussions about the debt ceiling. We'll see where that goes.
And silver as well. I don't do SLV, but that was up 2.28. Let's see what GLD was. GLD was up 1.36%. Well, GLD was up more than the dollar was up versus the pound, which was like 1.2%. So there you go. Yeah, that's
So
interesting, Clive. The other, like you said, that watch what things do the first day or first week of the year. That's usually the trend for the year. And it's also sometimes like when you have economic data, some people say that the first reaction of the market right after the number is going to be the rest of the reaction for the rest of the day. Of course, that's a lot more short term. So I think today we don't have the jobs data. It's going to be on the 10th, Clive. So they're skipping it this week.
And maybe one more thing, Mario. If any of your viewers are equity buyers, I've published on the 31st of December on LinkedIn a 40 stock portfolio. That's what I think I will earn. It doesn't mean to say it's right for anybody else. I did the same thing a year ago, and that beat the benchmark. I'm hoping that this will do the same thing. There's been a huge amount of work put into picking the stocks. Obviously, I start with a database of several thousand, 3,000 plus stocks, narrow it down to around 100. Then I'm doing detailed research on those 100. I'm looking for things like growth, value, those types of things. But it's a mixture of a lot of different things that I'm looking for. And then as a final filter, I'm reading the last quarterly or half yearly earnings calls of the company. These are verbal things, but there's a transcript where the directors have been discussing the earnings and they get questions from analysts. So it's maybe something which doesn't go into the hard numbers, and you pick up a sentiment from the directors as to whether they're feeling positive, negative, neutral, making excuses. And I don't do all of that myself. I'm using artificial intelligence now to do the work, but it will kick back for me, and I've shown you a couple of examples of that, Mario, but it'll kick back for me an opinion as to the sentiment of the board of directors. And so I've put that into my thing. And I think that's because, of course, anyone can run a filter. So I'm going beyond what most investment firms do, which is running a filter. I'm actually looking at the feeling that people are getting inside that face-to-face earnings call to try and determine out of the very short list which of those shortlist stocks should go into my list. Now, it's not investment advice, but I think it's a very sound list for somebody who'd like to play with equities.
So it looks like your retirement is very active, Clive, which is good. Just wanted to show here the silver junior silver miners yesterday. I think they were up 5.94%. So there you go.
It just shows you where the money's going.
Yeah, great, Clive. Thank you for your time again. And let me know later on if you want to come on Sunday for the live stream as well. And to all the viewers, yeah, have a great weekend.
Thank you, everybody. Thumbs up. Have a great weekend.